Let me ask you something honest. Have you been meaning to start investing? Like, actually start. Not just think about it. Not just watch videos about it. Actually open an account and put money in. If the answer is yes, but you have not done it yet, you are not alone. Studies show that nearly 50% of Americans have zero money invested in the stock market. Zero. Not because they cannot afford to. Not because they are bad with money. Because nobody ever showed them exactly where to start. And today, that changes. At the end of this video, you will know exactly how to build your first investment portfolio from scratch. Even if you know absolutely nothing about investing, even if you only have $100, even if the stock market genuinely scares you, let us build this thing together. Welcome to Invest Framework, the channel where we break down money, investing, and wealth building in the simplest way possible. If you are ready to finally take this step, hit that like button right now and let us get into it. Before we build anything, you need to understand one fundamental truth about money. Money sitting in a savings account is slowly losing value, not because the number goes down, but because inflation goes up. Right now, the average savings account in America pays around 0.5% interest per year. Inflation historically runs around 3% per year, which means if your money is sitting in a regular savings account, it is effectively losing around 2.5% of its purchasing power every single year. At $100 you have sitting in your savings account today will only buy you about $97.50 worth of stuff next year. And the year after that, even less. Now compare that to the stock market. The S&P 500, which tracks the 500 largest companies in America, has returned an average of approximately 10% per year over the last several decades. Through recessions, through crashes, through wars, through pandemics. 10% average per year. That same $100 invested in an S&P 500 index fund becomes $110 after 1 year, $159 after 5 years, $259 after 10 years, $672 after 20 years, from $100. No extra work, no extra contributions, just time and compound growth. This is why investing is not optional if you want to build real wealth. It is essential. Now, before you invest a single dollar, there are two things you must do first. Not suggestions. Requirements. Requirement 1. Build your emergency fund. An emergency fund is 3 to 6 months of living expenses sitting in a liquid, easily accessible savings account. Not invested, not locked away, just sitting there ready for any unexpected expense. Car breaks down. Emergency fund. Unexpected medical bill. Emergency fund. Lose your job suddenly. Emergency fund. Without this cushion, any financial emergency forces you to sell your investments at the worst possible time. So emergency fund first, always. Requirement 2. Pay off high-interest debt. If you are carrying credit card debt at 20% interest, paying that off first is the guaranteed best investment you can make. Because paying off 20% interest debt is the same as earning a guaranteed 20% return. The stock market cannot promise you that. Once you have your emergency fund and your high-interest debt is cleared, now you're ready. Let us talk about what a portfolio actually is. A portfolio is simply a collection of investments, like a basket. And what you put in that basket determines how your money grows. There are 3 main things most beginner portfolios contain. Number 1, stocks. When you buy a stock, you are buying a small piece of ownership in a company. If the company grows, your piece grows too. Stocks offer the highest potential returns, but also the most short-term volatility. Number 2, bonds. Bonds are essentially loans you give to companies or governments in exchange for regular interest payments. Much less volatile than stocks. Much lower returns. But they add stability to your portfolio. Number 3. Index funds and ETFs. This is where most beginners should start. An index fund is a single investment that automatically owns a tiny piece of hundreds or thousands of companies at once. Instead of picking individual stocks and hoping you chose right, an index fund lets you own a tiny piece of the entire market. The most famous example is the S&P 500 Index Fund. One purchase gives you exposure to Apple, Microsoft, Amazon, Google, and 496 other major American companies simultaneously. Instant diversification, minimal effort, historically excellent returns. Now let us build the portfolio itself. The simplest and most proven beginner portfolio is called the 3-fund portfolio. It was popularized by John Bogle, the founder of Vanguard and one of the most respected investors in history. Here is how it works. Fund 1. U.S. Total Market Index Fund. This single fund owns a piece of virtually every publicly traded company in America. Large companies, small companies, growth companies, value companies, all of them, in one fund. This is your growth engine. Recommended allocation, between 60 and 80% of your portfolio. Fund 2. International Index Fund. This fund owns companies outside of America, Europe, Asia, emerging markets. Why does this matter? Because the U.S. market does not always lead the world. There are years when international markets significantly outperform the U.S. market. Owning both reduces your risk. Recommended allocation, between 10 and 20% of your portfolio. Fund 3. U.S. Bond Index Fund. Bonds add stability. When the stock market drops, bonds often hold their value or even increase. This cushion helps you stay calm during market downturns instead of panicking and selling. Recommended allocation, between 10 and 20% depending on your age and risk tolerance. A simple starting point is this formula. Your age as your bond percentage. If you are 25 years old, 25% bonds, 75% stocks. If you are 40, 40% bonds, 60% stocks. Younger investors can afford more risk because they have more time to recover from downturns. Now you need a place to actually invest. This is called a brokerage account. For most beginners in America, there are 3 excellent options. Option 1, Fidelity. Fidelity is one of the most trusted brokerages in America. 0 trading commissions. 0 account minimums. Excellent educational resources for beginners. They offer their own index funds with 0 expense ratios, meaning you pay nothing in annual fees. Option 2, Charles Schwab. Another industry-leading brokerage with 0 commissions and 0 minimums. Excellent customer service. Great selection of low-cost index funds. Option 3, Vanguard. The original home of index fund investing, John Bogle founded Vanguard specifically to give everyday investors access to low-cost index funds. Their expense ratios are among the lowest in the industry. Now here is something even more important than which brokerage you choose. The account type you open. If your employer offers a 401k with a company match, start there. A company match is free money. If your company matches 50% up to 6% of your salary, contribute at least 6%. That is an immediate 50% guaranteed return. Nothing in the market can beat that. After maximizing any employer match, open a Roth IRA. A Roth IRA lets your money grow completely tax-free. You contribute after tax dollars, but all the growth, all the compound returns over decades come out completely tax-free in retirement. For 2025 and 2026, you can contribute up to $7,000 per year into a Roth IRA. This is one of the most powerful wealth-building tools available to everyday Americans. Now let us talk about the mistakes that cost beginners the most money. Mistake 1. Trying to time the market. Trying to buy at the perfect low and sell at the perfect high sounds smart. It is not. Professional fund managers with billions of dollars and teams of analysts consistently fail to time the market correctly. You will not be the exception. Time in the market always beats timing the market. Start now. Stay invested. Do not try to be clever. Mistake 2. Panic selling during downturns. The stock market will drop. Guaranteed. It dropped in 2008. In 2020. It will drop again. The investors who got hurt the most during every crash were the ones who sold in panic. The investors who stayed, invested, and kept buying during the crash. They recovered and then grew significantly. Market downturns are not disasters for long-term investors. They are sales. Mistake 3. Waiting for the perfect moment. The best time to start investing was 10 years ago. The second best time is today. Not next month when you feel more ready. Not next year when the market seems calmer. Today. Every month you wait is compound growth you will never get back. Here is your exact step-by-step action plan. Step 1. Build your emergency fund first. 3 to 6 months of expenses in a high-yield savings account. Step 2. Pay off any credit card debt. High-interest debt before investing, always. Step 3. Open your account. If your employer offers 401k matching, contribute enough to get the full match first. Then open a Roth IRA at Fidelity, Schwab, or Vanguard. Step 4. Choose your 3 funds. U.S. Total Market Index Fund. International Index Fund. U.S. Bond Index Fund. Keep it simple. Do not overcomplicate this. Step 5. Set up automatic contributions. Even $50 a month invested consistently builds something significant over time. Automate it so you never have to remember. Step 6. Never look at your portfolio every day. Checking your portfolio daily creates emotional decisions that cost you money. Set it up. Automate it. Review it once every 6 to 12 months. Step 7. Never stop. The most important step is consistency. The market will scare you sometimes. Stay invested anyway. Building wealth is not complicated. It just requires starting. The 3-fund portfolio. A tax-advantaged account. Automatic contributions. Time. That combination has made ordinary people financially free for decades. It will do the same for you if you actually start. The only thing standing between where you are now and a growing investment portfolio is making the decision to begin. So close this video. Open your brokerage account. Make your first contribution, even if it is just $50. Because $50 invested today is worth more than $500 you invest 5 years from now. Start small. Start now. Stay consistent. If this video finally gave you the clarity to start investing, hit that like button right now. Subscribe to Invest Framework for simple money and investing lessons every single week. And drop a comment below telling me, are you a complete beginner or have you already started investing? I read every single comment. Thank you so much for watching. I will see you in the next one.